Hi, this is Trevor Hammond of McKenna Financial, and this is a brief overview of our powerful investment property analyzer. This is a tool that we help real estate investors make key decisions regarding their investments and how to maximize their rate of return when owning investment real estate. I will walk you through some of the key components of the tool and show you the various results we can get by utilizing this tool when analyzing various properties to purchase or trying to decide whether to hold on to a current property or sell it. In this example, these example clients are buying a $350,000 property and they plan to put 20% down for a loan of $280,000. We have a tax assessed value on the property of $325,000. The land allocation is 35%, and this is a key number to calculate the depreciation tax benefits. We have decided that the down payment will not come from a 1031 tax deferred exchange account, meaning these clients have not sold a previous investment property and are rolling the proceeds tax deferred into this new property. If we do need additional money to improve the property, we can plug that amount in here. It's a single unit property, and we anticipate earning $1,595 a month in rental income. We can plug in the loan information, $280,000 at a rate of 6.5%, for example, a 30-year mortgage. It is not interest only. And what you'll see is it's already starting to calculate on an annual basis how much rent we expect to receive, how much interest we expect to pay per year. Over here it'll calculate how much money we need at closing, estimate of closing costs, any improvements we need to make to help the investor realize how much money they may need to get into this property. It'll calculate the mortgage payments for us, not including property taxes and home insurance, and figure out what that is annually. And next we start plugging in the specific variables on the property that we are analyzing, such as the property taxes, the home insurance, annual maintenance expenses, whether or not we're going to use a management company, which becomes a key decision maker for many investors, whether they're going to do it themselves or hire a management company. We can plug that expense in and also take it back out to see how that affects the long-term rate of return for this investment. What we're trying to calculate is the total property expenses per year on this house. We can also make estimates of how many months each year do we anticipate the house being vacant and not rented. Then we'll plug in the tax brackets, the capital gains rates, the estimated holding period that the investor plans to own this property, and we can make assumptions on the appreciation per year during that holding period, potential rent increases during that holding period, and whether or not we think the operating costs will go up during our holding period. When it does come time to sell, we will have real estate expenses, and we can also again answer the question if we are going to utilize a 1031 exchange account to roll the proceeds of this property into another like investment property. So there's two reasons we own investment real estate. Number one is cash flow. The second reason we teach is for long-term appreciation and wealth. So first, with this tool we look at the cash flow on a before-tax basis and then on an after-tax basis. Obviously, investors understand there are a lot of tax benefits associated with owning investment real estate. So the results of all of the above data come out like this. We anticipate earning $19,000 in income from our rents. We anticipate spending $64.81 in operating expenses for a net income of about $12,600. We have about $18,000 in interest expense, meaning that our cash flow before taxes, not including principal reduction on the mortgage, is a negative $5,500 per year. When you include the principal reduction on our mortgage payments, it's a negative $8,579 per year. Now we separate those out because When you really think about principal reduction, that is money you will get back someday. It's paying yourself back. Then we want to look at the after-tax cash flow. The biggest tax benefit that investors receive is the ability to depreciate the property. In this case, you'll see in this example, they have a tax savings of $4,647 each year. Now this will offset their cash flow before taxes. So in summary, you'll see that this investor in this example, before any tax savings, is a negative $8,579. But we can estimate they will receive back approximately $4,647 when they do their tax returns, resulting in cash flow after tax impact of negative $3,932 or $328 per month. So probably the key question that we've gotten the most over all the years of helping investors is, does it make sense to feed the property? And the answer is, it depends. It depends on the future value of that house and the long-term wealth that we may get as we feed it. So next we look at, with our assumptions we plugged in above, what the resulting proceeds after a 5-year or a 10-year holding period look like. In this example, we bought the house for $350,000. We anticipated a 5% rate of return per year, and we're going to hold it for 5 years. This results in the house going up to $446,000 when it comes time to sell. It'll go through the math for our investors, and we can help them see total gain on sale of $104,522. With a capital gains rate of 15% and the fact that we have to pay back 25% of the depreciation benefit we took during that time, we have taxes due upon sale of just under $20,000. We would be looking at an after-tax proceeds from selling this house of $138,000. During the 5 years of holding it, we had a cash decrease of $20,000, and that is because we had a negative cash flow even after the tax benefits. So down here we get to see if that was worth it. We end up with an increase in wealth of $117,800, even though we fed the property $327 per month during that time. So that is a big number. What this tool is designed to really do, though, is help investors understand how this investment compares to other potential investments with their money. In this case, we made a lot of money, we fed the house a lot of money, but the key answer is that this property gave them a return of over 9% per year on their investment. And now an investor has a clear picture of whether or not investing in this property is a good decision versus investing it elsewhere or potentially another property. I hope this helps paint a clear picture on how powerful this tool has been for many investment clients, and I hope it can help you too. We wish you all the best. If you have any questions, you can call us at 503-597-2550 and ask for me, Trevor Hammond. You can also visit us at our website at www.makena.financial.com. That's MAKENA financial.com.